Good morning, Jimmy.
Jeremy, how are you?
I'm doing great. We're at the tail end of summer.
Yep.
We're talking about this concept called advisor alpha. And let me just say, without a whole lot of hyperbole, this might be one of the more important two fiduciaries that we've done.
Oh, I totally agree. I mean, I love this study. It's been around for a long time now. It's wonderful, quantification of the advisory value.
Exactly. So if you're thinking about hiring an advisor, we can't tell you who to hire exactly,
Right.
but this is based on a study that gives you the rationality as why you would want to hire a good advisor.
Correct.
And it's such a big important thing for people, and you can't change some of these decisions that you're going to make.
Right.
So we really want to help influence people to make good decisions. That's a lot of what advisors do.
Right.
So this study that we're going to talk about is now 25 years old. We'll get right
25
into it.
years. Wow.
So what is advisor alpha? I would tell you that you were the first one to have introduced me to this concept
Right.
some 10 plus years ago.
Yep.
So what is it?
So alpha is the term for outperformance. Okay, and advisor alpha, we got to give major props here to Vanguard for being the originator of this study and explaining what advisor alpha is. But you can see the key components here. The asset allocation, investment selection. I think that's where most prospects' minds originally will lock into. That's where they think the value lies with
Sure.
working with an advisor. But as we know, and as we have preached, and as our clients have experienced, there's a whole lot more that goes on other than just picking different funds or stocks or bonds, right? So there's the financial planning and wealth management. There's the whole practice management, the client experience, and then the behavioral coaching that goes along with it. So advisor alpha is how can working with an advisor allow you to do better or perform better than what you would have been able to do on your own.
So it's interesting because Vanguard 25 years ago says, we believe that these four puzzle pieces
Yep.
are going to be things that produce outperformance for their
Long
clients,
periods and over long periods of time, right?
right? And so they all stand to reason in a lot of ways. They weren't particularly popular back then. They're more popular today than perhaps ever, but they're still like in the early stages here. I think what's really interesting is now, 25 years on,
Right.
we've got the data.
We do.
And that's really cool. So that's what we're going to show you next. So can an advisor actually be quantified? And the answer is yes.
Right.
So they've looked at all these different strategies within the advisor alpha kind of ecosystem. And we've got the asset allocation with diversified funds and ETFs. You got investment selection, rebalancing, behavioral coaching, asset location, tax efficient retirement strategies, total return versus income investing, and tax loss harvesting. That's a new one, by the way, that they put in there. And then on the right side of this chart here, they add these up in terms of basis points. Okay, so remember, 100 basis points equals 1%.
Correct.
So there's different ranges of outcomes that you're going to experience
Right.
with these that are very unique to the individual.
Correct. Yeah. I mean, the impacts of, what account types do you have? What's your total asset level? What's your income tax rate? There's a lot of different factors that go into creating this relative average for each individual client. But what I love about this is that we are quantifying it because,
Yep.
again, the concept of financial planning, I think, is often a nebulous concept for individuals when they're first really being introduced to it or first considering working with an advisor. It is a bit of a nebulous concept. What does it
Definitely.
even mean?
Yeah.
Right. And as we know, as CFPs, there's so many different disciplines that fall underneath the financial planning umbrella.
Yep.
Right. And so, Vanguard, again, kudos to them for taking the time to do the research. And we love that this isn't our data. This is an independent study from a very well-respected firm, right? But to give you the numbers on each of the different, alpha strategies that they have identified as being potentially very beneficial for clients, and then again applying it to their individual situation to figure out how much might working with an advisor help me in the long run.
Right. So when you get to the bottom, the range of potential value added in terms of basis points, is 300 or more. That's 3% or more.
Right.
And again, might not sound like a lot, but we know in the world of investing, 3% compounded year over year over year
Huge
is
number.
massive.
Yes, absolutely.
So massive. And there's a couple of areas that are, particularly you can see them here that are particularly strong: behavioral coaching, tax efficient retirement strategies.
Yeah.
Tax loss harvesting is a new thing that they've included in the study, and they're saying up to 150 basis points or more. We preach a lot about things like direct indexing and how
Right.
that's really valuable.
Yeah, we love it.
Love to see that they're including that in there. But there are a myriad of different things that are all adding up to the value that a good advisor can produce, and it is significant.
Absolutely.
But guess what? It's still the early innings of this. Believe it or not, 25 years on, or I guess about 23 to 24 in this
Right.
particular example. And we're seeing that some of these things are being widely adopted and used in the marketplace, and some of them are just in those nascent stages. They're just beginning.
Right. So we've mentioned the direct indexing, the tax loss harvesting component. Let's just focusing on that one for a second here. So that is on the bottom of the graph here. You can see back in 2001, solid red, very limited. Right? It was viewed at that point in time only to be applicable to high net worth individuals. Well, guess what? Tax loss harvesting, direct indexing is being democratized, right? And in full transparency, Vanguard has been part of the movement of democratizing low cost investments and diversified portfolios for individuals for as long as they've been around.
Exactly.
Right. So you kind of know once Vanguard gets into something, once they launch a new product or new service, that the intention is to be able to distribute it to the masses.
Right.
And so tax loss harvesting here, now you're starting to see a little bit of the yellow in there here in 2024, and I would venture to guess, given our interaction with Vanguard and the time that we spent with them out at Future Proof last year, this is only going to continue to grow.
No doubt about it. They're actually seeing the light, and perhaps most importantly, some things that we've known for a little while about, like tax loss harvesting, are now becoming more capable because technology is supporting them as well.
Right, absolutely.
So the whole point of this is there's a lot of good forward progress, yes, but there's also still a lot of progress to yet be made.
Absolutely.
All right, so what are some of these positive outcomes? Well, number one, and so these are all kind of captured in this thing called return leakage. If you can imagine you have a boat, right?
Right.
And you've got holes in your boat.
Yeah.
You're going to be constantly bailing water.
Right.
Right. You're going to, one good thing in, one good thing out, whatever. It's just a tough scenario. So stop the leakage and you're going to have better outcomes.
Right.
Number one here is advisor fund selection criteria. So we've looked at this now over the last 20 plus years. Pretty massive change.
Big time.
It used to be a lot of mutual funds.
Right.
Now it's ETFs.
Right.
It used to be really high cost. Now it's lower cost. Advisors are having a role in selecting these ones and sort of through natural selection getting rid of some of the high cost, tax dragging, performance kind of laggards, if you want to put them that way.
Right, absolutely. One of the numbers that jumps out at me here, so in this whole advisor fund selection criteria and looking at the data we have to the right of it, you see this whole percentage of index equity mutual fund and ETF assets. Back in 2001, you're looking at 13%. Now, and this is only as of 2023, I would assume now, if you updated the data, here in 2023 is 58%. I bet you it's at least 60% at this point in time. So you're talking about going from 13% up to 60% of invested assets have moved from being in those low cost, well diversified funds into we went from 13% to 60%. So individuals by and large are now experiencing potentially better returns just from a reduction of the cost of the investments that they're allocated in.
Exactly.
Right? And that's been something that Vanguard, again, has championed for quite some time.
They have. And a lot of companies have followed their suit. And I want to say something to the effect of it's saving investors $140 billion a year annually.
Right.
So I mean, it's no drop in the bucket.
Right. No, absolutely.
Next one here, number 2, is advisors maximizing after-tax returns. So this one speaks to us pretty closely. Asset allocation, meaning putting the tax-efficient assets in the right buckets, whether it's qualified or non-qualified retirement accounts or brokerage accounts. Tax loss harvesting, we've talked a little bit about that. And algorithmic trading has really enabled a lot of things to take place that weren't possible, that were manual before. So you can do things with speed, and technology is enabling them.
And in addition to that, if you remember a few years back, there used to be trading costs on these, buying individual stocks, right? And then trading costs have effectively gone to zero. I mean, at almost every brokerage firm now, if you're buying an individual stock, there are no more commissions or costs associated with that. So the tech combined with the reduction of costs has, absolutely increased the rate at which they're able to roll out the technology for the masses.
There's a lot of details in advising to a lower tax profile.
Right.
A lot of details. If people are interested, happy to talk to you. That's our language. Number 3 here is behavioral coaching. Stopping folks from making bad decisions is part of not just making good decisions, stopping bad ones.
Well, we talk, I mean, it's almost at every, 2 fiduciaries or some of our longer, the quarterly investment reviews, we always are talking about the importance of building a financial plan, right? And building that plan, we certainly believe is setting the foundation for you to have better context around the potential, bad events that might happen that we have no idea what they're going to be, but we know they're going to come at some point in time. And preparing investors and clients emotionally to handle those, because we've run the numbers for them, and then that way we can prove out objectively you can withstand these downfalls, right? If you continue on the proper track with the proper behaviors, you can withstand these, the pitfalls that we're going to have in the future. So super important that, when you have done the work with an advisor that has done, a good job of building a comprehensive plan, you're much more confident in the ability for you to withstand the choppy waters ahead.
And that's so well put. We've got the circuit breaker in there because, look, this is your opportunity to train yourself, and with the help of an advisor, on how to manage through difficult scenarios, because it's not a matter of if, but when.
Correct.
Now, again, this is all about quantifying things. So we're talking about, okay, if you have leakage, if leakage is a fact in people's portfolios because of the various things we've been talking about, how do you stop that leakage? How do you patch the holes in the boat? And what impact does that have? So in a quick fire look at this is 30 years of investing. You start with $100,000. The average rate of return is 6% per year. What if you have a high leakage boat?
Yeah.
What if you have almost a no leakage boat?
Right.
Okay. The advisor's trying to get you to the point where you're almost a no leakage boat.
Right.
And so the differences are pretty massive.
Yeah. Again, this is, we joke about this, but the impacts of compounding over long periods of time, and quite frankly, this is a low number because the study showed that the value is 3% or more, right? So the numbers here are conservative because the highest amount of leakage that we're showing here is 2%.
Right.
But when you look at the top to the bottom here of the lowest leakage compared to the most leakage, you're talking about over $240,000 of difference in the ending portfolio value over 30 years on a $100,000 initial investment.
It's massive.
I mean, think about that.
Yeah.
Right? That's crazy to think about. The numbers are hard to process. You almost feel like you have to go back and recheck the math to make sure that it's actually right. But this is the effects of compounding interest over long periods of time. And this is at $100,000 portfolio. You make it $1 million, and the numbers just get larger.
That's right.
So
and
super impactful.
It also speaks to, and again, the same way, maybe said a different way, but it speaks to the marathon-like approach that you should have on your finances.
Absolutely.
Because you don't start to even see really the breakaway until about 10 years into this cycle.
Yeah.
And then all of a sudden you really start to see it.
Exactly.
And then it really starts to heat up. So again, it is a marathon. It's not a sprint. How we talk about it all the time. One of our core cultural values here at On Track Wealth Management is decades, not days.
Right.
So this really speaks to that.
I couldn't agree more.
Well, that's all we have.
That was fun.
But this is important. We hope everybody was able to stick through this with us in the last 15 minutes because this is a hugely important subject area. If anybody has any more questions on this, please reach out to us. Happy to talk.